$1.3 trillion gone in 2 days. That is not a typo. AI chip stocks just suffered their worst 2-day sell-off in history, and buried inside the numbers is a signal that almost nobody is talking about yet. Welcome back to AI Assets, your daily edge on AI investments. The Philadelphia Semiconductor Index fell nearly 8% in 2 days. Nvidia is now 26% below its May high. And GPU rental prices, the real-time market for AI computing power, have collapsed 31% in just 3 weeks. This is not just a stock market story. It is a signal about the future of AI infrastructure demand. And it changes how you need to position your portfolio right now. Let's break down exactly what happened, what it means, and what smart investors are doing today. What actually happened starting June 26th, a wave of selling swept through every AI-exposed semiconductor name globally. Nvidia led the decline, now sitting 26% below its May all-time high. SK Hynix fell 8.4%. Samsung dropped 5.3%. The selling spread to Japan, where SoftBank collapsed 12.5% and dragged the Nikkei down 4.2%. In the US, ON Semiconductor fell 24.5% after announcing a $7 billion acquisition that markets rejected instantly. But here is the number that matters most. GPU rental prices on cloud infrastructure marketplaces have fallen 31% in 3 weeks. This is the actual spot market for AI compute. When the companies renting out GPU capacity start cutting prices this aggressively, it means one thing: supply is outrunning demand right now. Investor context: which stocks are most exposed? Let's talk about your portfolio directly. The most obvious exposure is Nvidia. A 26% drawdown from the high sounds dramatic. But remember, Nvidia's revenue is still growing at over 70% annually. The question is not whether the business is good. The question is whether the valuation priced in perfection, and whether the GPU rental data signals a demand slowdown that will show up in earnings. Broadcom is a cleaner story here. Their AI chip revenue is driven by custom silicon, Jalapeno with OpenAI, custom TPUs with Google, and does not depend on the open GPU rental market. AVGO is more insulated from spot price pressure than Nvidia. Memory names are the most immediately exposed. Micron, SK Hynix, and Samsung all supply high-bandwidth memory to AI accelerators. When GPU utilization rates drop and rental prices fall, memory demand softens in the next procurement cycle, typically 60 to 90 days out. If you are holding memory names with high valuations, this data should make you pay close attention to guidance. The relative winner in this environment is energy infrastructure. AI data centers consume enormous power regardless of short-term GPU utilization rates. Companies like Vistra, Constellation Energy, and NextEra have more durable demand than chip companies because the buildings and cooling systems stay on, even when compute is underutilized. What the market is missing here is the angle most analysts are skipping entirely. Everyone is debating whether AI demand has peaked. That is the wrong question. The real question is, who was renting those GPUs at peak prices, and why are they now renting less? The answer is AI startups and mid-market companies that were burning venture capital dollars on compute to train and deploy models. As funding conditions tighten and the focus shifts from growth to margin, exactly the regime shift we covered last week, These companies are reducing their compute spend first. The hyperscalers, Microsoft, Google, Amazon, Meta, are still expanding capacity. Their Capex guidance for 2026 has not changed. They are not driving the GPU rental price collapse. What is driving it is the second tier of the market. And that second tier is exactly the customer base that was supposed to justify the next decade of semiconductor demand growth. This is a warning shot, not a death blow. But the market is treating it as a temporary dip in a growth story, when it should be treated as a structural signal about AI's revenue model at the application layer. What happens next here is your concrete roadmap for the next 60 days. Watch Nvidia's earnings in August. Jensen Huang will face direct questions about data center, revenue growth rates, and hyperscaler order trends. Any reduction in forward guidance will accelerate this sell-off dramatically. Any upside surprise will trigger a sharp recovery. This is the single most important earnings call for the AI sector in 2026. Watch Microsoft and Alphabet report in late July. Both companies will report Azure and Google Cloud revenue, and the AI attach rates in those numbers will tell you whether enterprise AI demand is accelerating or plateauing. These reports come before Nvidia and set the tone for the entire sector. Watch GPU rental prices weekly. Sites like Vast AI and Lambda Labs publish real-time GPU compute pricing. If the 31% decline stabilizes, it signals that supply and demand are rebalancing. If it continues, it signals a more serious demand problem, and another leg down in semiconductor stocks is likely. For positioning, reduce exposure to pure-play GPU and memory names that are priced for perfection. Shift weight toward infrastructure companies with locked-in contracts, AVGO, power infrastructure, and hyperscalers with diversified revenue. Hold some dry powder. The companies with the cleanest balance sheets and the most durable AI revenue will be the ones you want to buy aggressively when this shakeout ends. The trillion-dollar sell-off is a signal. Smart investors read it before the next one arrives. And that is exactly what we do here on AI Assets, every single day. If you want to stay ahead of the AI investment curve before mainstream media catches up, subscribe to AI Assets right now and hit the notification bell. We drop fresh analysis daily. No noise, just signal. Drop your thoughts in the comments. Do you think the GPU rental price collapse is a temporary correction or a structural signal that AI infrastructure demand has peaked? I want to hear your take. See you in the next one.